Bitcoin's price changes every second. But have you ever stopped to ask, who is actually moving it? And why does the same Bitcoin have different prices on different platforms at the same time? Sometimes the market explodes upward, other times it crashes in minutes. So what really triggers these moves? In this video, we'll break down how the crypto market works step by step, so you'll finally understand how crypto is priced, why prices differ across platforms, and what truly causes big price movements. By the end of this video, you won't just see a crypto coin price rising and jump in, you'll understand the motive behind the market rally and whether it is the right time to buy or not. But before then, let's look into what cryptocurrency is. Cryptocurrency is a form of digital money that lives on the internet. Think of cryptocurrency as digital cash you can send to anyone in the world or use to pay for goods and services, without the need for a middleman like a bank. Unlike traditional money, no bank or single authority approves cryptocurrency transactions. Instead, they are verified and recorded on a public blockchain, which acts as a digital ledger. If you want to know more about blockchain, check out my detailed video on blockchain. Now, let's look at how the crypto market works. I know you might have asked this question before. Where do people buy and sell cryptocurrencies like Bitcoin? The simple answer is a crypto marketplace, which you can also call a digital marketplace or crypto exchange. A crypto exchange is simply a platform that connects people who want to buy crypto with people who want to sell crypto. That's why it is called an exchange. For example, think of it like a market square that sells foodstuffs. You don't buy tomatoes from the owner of the market. Instead, you buy from another person who came to the market to sell tomatoes. The market owner only provides the space and makes sure everything runs smoothly. Crypto exchanges work the same way. Some of the popular crypto exchanges are Binance, Coinbase, and Bybit. These platforms provide a marketplace where buying and selling happen. Most of the time, they are not selling you Bitcoin directly. They are simply connecting buyers and sellers and recording the transaction. Now, this is how it works. When you place a buy order for Bitcoin, the exchange matches you with someone willing to sell at that price, completes the trade, and records it. Now, you might be wondering, do all these platforms work the same way? The simple answer is no. There are two main types of crypto exchanges: centralized exchanges and decentralized exchanges. A centralized exchange is a crypto exchange that is run and managed by a company like Binance, Coinbase, or Bybit, which we mentioned above. Think of a centralized exchange like an organized shopping mall, where the management sets the rules, keeps things running smoothly, and makes sure buyers and sellers can do business safely. Decentralized exchange, on the other hand, is a crypto marketplace that operates without a company or central authority. An example is Uniswap and PancakeSwap. Think of a DEX like a peer-to-peer market in your neighborhood, with no company or manager controlling the stalls. Buyers and sellers meet directly and make trades according to agreed-upon rules. Now, with the explanation above, you can see why many crypto traders prefer centralized exchanges. They offer security, clear rules, and regulated systems, which help protect your funds and reduce the risk of scams. That's unlike decentralized exchanges, which give you full control of your crypto, but there is no central authority, no regulation, and no guarantees. Major crypto scams like rug pulls and pump and dump scams happen mostly on decentralized exchanges due to limited oversight. Now, someone might ask, how do I buy crypto on these platforms? It's very easy. Platforms like Binance offer a clean, simple interface for buying and selling coins. However, you might be asked to complete verification steps for security and regulatory purposes. But remember, the price you see on the platform is not set by Binance or any company. It reflects the current price where buyers and sellers agree to trade. So, when you click buy or sell, the exchange simply matches you with someone on the other side of the trade, and the market decides the price in real time. This brings us to the next point. Who sets crypto prices? Crypto prices are set by supply and demand, just like in any market. When more people want to buy a cryptocurrency, the price goes up. When more people want to sell, the price goes down. The exchange doesn't set the price. It only shows the current price where buyers and sellers agree to trade. Think of it like a local market. When many people want to buy tomatoes, and only a few people are selling, the price goes up. But when many people are selling tomatoes and fewer people are buying, the price comes down. The crypto market works like that. But have you wondered why the price of cryptos like Bitcoin jumps so fast? This is where our next point, liquidity, comes in. Liquidity simply means how easy it is to buy or sell a cryptocurrency without moving its price too much. For example, if you want to buy one Bitcoin and there is high liquidity, meaning lots of buyers and sellers, then when you buy, you'll notice that the Bitcoin price barely moves. Now, imagine you want to buy $10 million worth of a crypto token called BONK, which has very few buyers and sellers. That's low liquidity. The moment you place your order, the price jumps up immediately because there aren't enough sellers on the other side to match your trade. But something might happen when you click buy. Let's assume that you click buy at the price of $10, but the price you actually get is $10.20. This difference between the expected price and the price you actually get is called slippage. Think of it like this. Bitcoin is trading at $60,000, and you click buy. That's your expected price. In the milliseconds it takes for your order to reach the exchange and be processed, other trades might occur, or the available supply at that price level might run out. The price moves to $60,050, and your trade is filled at that price. That $50 difference is the slippage. Slippage can be positive or negative, depending on how the market moves. So what causes slippage? It usually happens when there is low liquidity, large orders, or sudden price volatility. For example, imagine a new token, XYM, is set to be listed at 9 a.m. You wait for the timer to reach 0. Now, immediately the coin is listed. You click buy, hoping to enter at that listing price. But when you check your account, you notice you bought the coin at a higher price than the actual listing price. For example, the XYM token was listed at $1, but your order was placed at $3 price level, which is higher. That's because many people are buying at the same time in those few seconds the coin was listed, and there aren't enough sellers. The $2 difference is the slippage. This shows how low liquidity and high demand can cause prices to jump instantly. You will observe that a few minutes after the token is listed, the price starts to drop because sellers are now entering the market. Early buyers begin to take profit, liquidity improves, and the price starts to stabilize. Now you know why cryptocurrency price jumps up within minutes, especially among low-cap tokens or newly listed tokens. That's why traders need to be careful when buying newly listed tokens or during highly volatile market moments. If you're not careful, you can fall for the trap and become their exit liquidity, meaning that when the price jumps up and reaches their target, they sell, leaving smaller traders with losses. And how easily this happens depends on trading volume. Volume shows how much of a cryptocurrency is being traded over a certain period. When volume is low, even small trades can push the price up or down sharply, making coins easy for whales to manipulate. Whales are individuals or entities that hold a very large amount of a particular cryptocurrency. Now, when volume is high, prices move more smoothly because many trades are happening at the same time, and it's harder for a single person's trade to drastically influence the price. In essence, price moves with liquidity, and volume determines how smooth or wild that movement will be. Now you might be thinking, who are the invisible people that provide liquidity to the exchange? They are called market makers. Market makers are large traders or firms that constantly buy and sell cryptocurrencies, providing liquidity to the market and helping reduce price gaps so trades can happen smoothly. Their main job is to keep the market active. Without them, it would be hard to buy or sell quickly, and prices could swing wildly even with small trades. We said earlier that crypto exchanges provide a platform that connects buyers and sellers. But have you ever wondered what happens when there aren't enough buyers or sellers? This is where market makers also come in. To make sure you can always buy or sell instantly, exchanges rely on market makers. They provide liquidity, which means there are always tomatoes on the table when you come to the market. Without them, you might have to wait a long time for another individual to show up and take the other side of your trade. Now, you might think, why isn't Bitcoin's price exactly the same on Binance and Coinbase? That's because each exchange is its own marketplace, with different liquidity and trading volume. If one exchange has more buyers than sellers, the price there will be slightly higher. If another has more sellers than buyers, the price will be slightly lower. Think of it like two open markets selling the same tomatoes. In one market, many people are rushing to buy, so sellers raise their prices. In the other market, fewer people are buying, so sellers are willing to sell for less. The tomatoes are the same, but the prices differ because demand and supply are different. This is why you see small price differences across exchanges. They are simply the result of supply, demand, liquidity, and volume working independently in each market. And this is where smart traders step in to harness the opportunity. These traders are called arbitrage traders. Arbitrage traders look for price differences between exchanges and take advantage of them. For example, if Bitcoin is cheaper on one exchange and more expensive on another, they buy it where it's cheaper and sell it where it's higher. By doing this repeatedly, they increase buying on the cheaper exchange and increase selling on the expensive one. This process pulls prices closer together, which is why Bitcoin prices across different exchanges usually end up almost the same. Outside of that, the exchange may also temporarily act as the seller to make things fast and simple, most especially when you use a debit or credit card for purchase. But behind the scenes, that crypto is still coming from the broader market, supported by market makers and the liquidity they provide. So, whether it's through matching buyers and sellers or using market makers for speed and liquidity, the exchange's main role is still the same, which is to make trading smooth, fast, and reliable. Now back to crypto exchanges. Let's use Binance as an example. When you trade or invest in crypto on Binance, there are two main types of markets, spot and derivatives. I have a detailed video on trading versus investing. You can check it out. The difference is that on the spot market, you buy the actual coin and own it. But on the derivative market, you don't own the coin. You are only trading price movement. Remember this, the derivatives market is much larger than the spot market, with long and short trades, high leverage, and liquidations. But market makers provide liquidity in both, keeping trades smooth. I know you will ask, what do long, short, and liquidation mean in simple terms? In the long trade, you believe the price will go up, so you buy, hoping to profit from the rise. However, in the short trade, you believe the price will go down, so you sell, hoping to profit from the drop. Now, liquidation happens when the price moves too far against your trade. The crypto exchange forces the closure of your position, and your money is lost. But if you simply buy and hold a crypto coin in the spot market, you cannot be liquidated, regardless of how far the price drops. The only thing is that your portfolio will drop significantly. Remember, not all crypto moves are unpredictable. Stablecoins play a very important role in calming the market and providing liquidity. A stablecoin is a type of cryptocurrency designed to keep a stable price, usually tied to the US dollar. For example, USDT is a stablecoin, where 1 USDT is equal to $1. Its price mostly stays the same even when the crypto market is booming or crashing. Stablecoins like USDT help calm the market and provide liquidity by acting like cash, letting traders move in and out of volatile coins safely. When stablecoin supply rises, like new USDT being minted, it often signals growing market momentum. And because crypto trades 24 hours globally, these inflows or major news anywhere in the world can move prices quickly. For example, when the Federal Reserve signals an interest rate cut, market sentiment shifts, and crypto prices often pump in anticipation of easier money. But when you hear news of a tariff war or an actual war, it could trigger a massive sell-off. This shows that crypto is highly sensitive to these conditions because it's a global market. Any major news, from interest rate decisions to wars or trade tensions, can trigger massive price rises or sharp crashes. To be on the safer side, smart traders combine news with charts to understand both what is happening and how the market is reacting before making decisions. Now you know how the crypto market works. Remember, this is not financial advice. This video is only for educational purposes. The crypto market is highly volatile and can wipe out your portfolio within minutes if you don't know what you're doing. Do not invest what you cannot afford to lose. If you found this video helpful, like, share, and subscribe. Thank you.